Hi, testing. This is Yongka here. Can everyone hear me? Hi everyone, good morning. This is Yongka here, the US Equities Analyst. Welcome to today's morning call. Okay, we are going to go through a few initiations that we had last week, as well as then we'll be wrapping up with the banking analyst. All right. So last Wednesday we had an initiation on Perennial Real Estate Holdings. Target price is $1.28, which is 20+% upside from today's share price of $1.44.5. Okay, so just a quick recap on what Perennial does. It's actually it's actually a RTO that completed in December. It's an RTO of St. James Holdings. So subsequently, it privatized its associate PCLT, and now there's three segments to it. One is the Singapore real estate, one is China department properties, and the third part is China completed investment properties. Today, it's trading at very attractive valuations of 0.57 times RNAV, which is lower than smaller SGX listed first sponsor, which is trading at 0.6 times today. First sponsor is actually about 1/3 the size of Perennial, and is backed by Hong Leong Holdings. Okay, so in terms, it's also locally owns real estate developer that is China focused. The shares are fully diluted will be 1.65B. Today is actually only about 1.2B because they have yet to complete the injection of Beijing Hongzhou Phase 1 and 2. So upon completion, you see that the fully diluted shares will rise to about 1.65, 1.7B, and RNAV per share, including the Beijing Hongzhou Phase 1 and 2, will be $1.83 per share. And our target price is based on 30% discount to RNAV. Our assumptions are very conservative. SG cap rate is 4 to 5%. China is 5.8 to 7.2%. Okay, just an illustration of why we say we are conservative. You look at the Patina Hotel at Capital Singapore, which is just across City Hall. They could be valued at 1.53 mil per room if we use the Westin Hotel's sale last year. But instead, because the income capitalization approach gives us a 930K per room, we are using the later lower valuations. Singapore real estate is underpinned by iconic properties. So what we have now is like Chimes, Capital Singapore. But at the same time, they also done very well buying old buildings. In the news recently, they formed a consortium to buy over 31. So Perennial will have a 31% stake in AXA Tower. Right now, they also have a 50% stake in 111 Somerset. And previously, Mr. Phua Sek Wan, he started off refurbishing Chinatown Point and 112 Katong. PRC Real Estate, their focus is on good connectivity. So it has to be well accessible by public transport, by the metro lines. They have about 19B of developments which are located in Beijing Hongzhou, Chengdu, and Xi'an, Zhuhai. These developments are self-funding. Why? Because they only intend to divest about 50% of the development, and then the other 50% will be held for long-term investment property income. So this 50% that will be divested will be recycled into development to complete the construction. At the same time, these developments were injected into Perennial on a full equity basis, so there is no leverage, and there's still some flexibility to lever up by credit lines. Completed properties is only via the PCLT. Then they have a few malls in Shenyang, one in Foshan, one in Chengdu. So these are doing pretty okay. We valued them at 4B RMB, which is actually a 43% discount to stated gross development value. Lastly, this company wouldn't be around if not for Phua Sek Wan. He's the one who is driving the overall company direction. So in all, when the Beijing Hongzhou has been injected in, 70% of shares will be held by reputable names. We have Koh Kung Hong of Luma, Wonsim Osim, and Phua Sek Wan itself. So all in, we think that 30% discount to RNV is appropriate to value Perennial. And actually, they are still on the market raising some funds, and there could be other opportunities as well. Next, we have F&N. So we also initiated last week with a reduce, with a 14% downside. So the last traded price is $2.82. Target price is $2.40. We think that F&N is set to lose its Myanmar beer business as compelled by a coalition. This results in a potential loss of about 1/3 in earnings, which you can see in the top right-hand chart. As there's only one bidder, we think F&N will not be appropriately compensated. The fair value is 1.3 B, but the initial offer was only 300 mil. In our projections, we assume the deal will go through at $1 billion. This will leave F&N with the slower growth soft drinks and dairies business in the bottom right-hand chart. In 2014, beer revenue grew by 20% and EBIT by 51%. On an overall basis, the F&N, the group only grew by a smaller revenue growth of 6% and EBIT of 29%. We also think that unfavorable FX movement will cause EBIT margin to contract. So again, as a result of the divestment of Myanmar beer stake, F&N will eventually trade at an unjustified premium 2016 valuation versus the peers. So one key question that we might be more concerned of is when will the sale of the Myanmar beer business take place, and at what price?
Good morning, everyone. This is Vincent, your macroeconomist. So, just to give you a brief outlook on the global economy. So, from the heat map, you can see that the developed markets are outperforming the emerging markets. They're still expanding, but at a slower rate. And you can see that in the Asian, the ASEAN side, particularly in Indonesia, the manufacturing sectors are actually contracting, and as well as at China, we can also see that signs that the economy is cooling down. So with this, we would be expecting more surprises and monetary easing ahead. We also we saw that PBOC actually took a rate cut last week on their required reserve ratio, which they have been refraining to do so for the past one year. Yeah, so that this step actually may backtrack what they have been trying to do by reining in their credit market, and also it might also reinflate the property market. So with more liquidity, this will be positive for equities as well as the credit markets in near term, and we're expecting that the monetary easing policies will be able to boost spendings for investment as well as prop up growth. And in terms of the foreign exchange, the exchange rate side, USD as well as capital flows should continue to drive the FX rate, with the capital flows effect to a lesser extent. Yeah, so we're expecting that currency especially in Indonesia and Malaysia to continue to depreciate. As for the US side, our view is actually that differs from what the market is actually talking about. We are expecting US to push back their normalization plan to probably at the later of second half of 2015, which is in contrast with market consensus of June-July period. So it is due to various headwinds. For example, the slowing demand, disinflationary pressures, geopolitical risks, as well as the renewed concerns on euro crisis. We are of the view that US, although their economy is picking up, they cannot decouple from the rest of the world. You can see that the US dollar is actually appreciating, which are compressing those export-related sectors, where you can see from here, export is actually trending downwards, is getting hurt, and for the manufacturing PMI is also being weighed down by the USD appreciation. And also US is actually importing disinflationary pressure from the rest of the world. As you can see, the core inflation rate is actually trending downwards as well. So with all these concerns, all these issues, we are of the view that US may push back on their monetary policy normalization. With that, I would like to pass on the presentation to Ben.
Hi, very good morning, everyone. Benjamin here, your financials analyst. So today I'll be giving a follow-up on the Singapore banking sector. Of course, we have seen the SIBOR going up over the course of last month. So we are going to evaluate the impact today. So to summarize our call before I start, right, our banks will still be an overweight for FY15, right, but going forward for FY16, we will give you the reasons why we should be cautious going to FY16. Right, so it's the key agendas for today. A couple of points, just about 4 to 5 sections for today. Right, first up, we are talking about the movement of the interest rates. So let's look back on the interest rate cycles that we have seen since 1999. Alright, so for ease of viewing, I've broken up the interest rate cycle into 4 different phases. So usually cycle movements in the interest rate cycle, it seems to have a predictive element in the share price performance of the banks, which I will show you later on. Right, so the key question is, are we going to see a repeat of the past performance that we have witnessed before? Right, first up, for I call it phase A, alright, where we've seen interest rates fell, right, in the earlier part of 2000. Alright, so SIBOR has dropped by about 191 basis points in the past during the phase A. Alright, so if you look over here, the banks have underperformed together with the STI. So the average return we had is about minus 11% over the course of 3 years. Alright, so over here for phase B, we see the interest rates are shooting up again. So 296 basis points going up. Alright, so as expected, the share price performance was about 50% over 3 years. Alright, so on a yearly basis, we are getting about 14.3%. Alright, so if you look at phase C, alright, the interest rates fell again. Alright, so the share price performance of the banks was negative 12% on a CAGR basis. Alright, so we move on to the final phase, which is phase D. Alright, so across the last 6 years or so, it was a bit of a unique scenario where the interest rate environment was extremely low. Alright, so for the banks and STI, actually we saw almost a doubling in the share price over the last 6 years, giving us about a 17% return per year for the last 6 years. So if you zoom into the last month, which I pulled up over here, alright, we've seen the SIBOR and then the SOR moving up, alright, over the course of last month. So the question is, right, since interest rates are about to turn, are we going to see a repeat of phase B, where the banks actually showed phenomenal share price performance? Right. So a bit more on the SIBOR side. Alright, so for SIBOR, usually it moves in line with the Fed fund rates. Alright, as you can see over here. Alright, so SIBOR usually is below the Fed fund rate, right? Since for the Singapore monetary policy, MAS always keeps the Sing dollar on a gradual upward appreciation path. Alright, but over the course of the last 6 years with the US QE, right, the SIBOR is actually above the Fed fund rate. Right, so the SIBOR, however, has actually moved ahead of the Fed fund rate over the course of last month, largely due to currency effects. So if you've been tracking the Sing dollar and USD, alright, Sing dollar has actually depreciated quite a bit against the US dollar. Right. So just to back up again, so for us, we believe that the SIBOR uptrend that we are seeing over here, alright, this has a ceiling because it's largely driven by currency effects. So for you to fully move, right, we got to wait until the Fed fund rate actually hikes upwards. So in line with our macroeconomist call, we are going of the view that this should move sometime in the second half of 2015, more towards the end. Right. So what is the impact of SIBOR moving up? Alright, so the first thing is quite clear that net interest margins for the banks will improve. So if you look at the loan balances breakdown over here for the 3 banks, alright, quite a large proportion of their loan books is denominated in Sing dollars. Alright, it's denominated, as seen by the blue part over here. Right, out of the Sing dollar denominated loans, right, around 40% is priced on SIBOR, 40% is priced on SOR. So total about 80% are floating, based on variable floating rates. So for You guys who have like mortgage loans out there, you know that repricing of loans usually takes between 3 to 6 months. So therefore, the impact of the SIBOR increasing will show up in loan yields going up probably around the second quarter of 2015 onwards, right? Since the SIBOR only moved last month. Right, so for the funding side, which we need to examine as well, since the loan yields go up, so we need to look at the funding leg to see if this goes up as well. Right, so for funding costs, we believe is relatively more comfortable. All right, considering that a bulk of the 3 banks' deposits are based on cheap current account, saving account deposits, so ranges from between 41 to 55%, and DBS has the highest proportion of the CASA balances, which I've mentioned quite a number of times before in our last few webinars. So if you look over here, right, this is interest rate cycle, and this is in net interest margins for the banks. Because if it takes 3 to 6 months, which is a couple of quarters, for the loans to reprice, so you can see that for the net interest margins, it usually lags by about 2 quarters, right, after interest rates move. All right, so DBS is best positioned for this when the SIBOR increases. All right, so with SIBOR increasing and the full rate hike, gradual rate hike to come in probably from the second half of 2015 onwards, right? Most people will be expecting that we'll be seeing a repeat of phase B, where the banks actually increase, right, in valuations, they re-rate, and we see a dramatic price performance. Right, so we look over here, we study the GDP growth against the loans growth. All right, for the GDP versus loans growth, we need them to be growing in line, right, to be considered as a healthy growth. All right, so we look over here where this is the phase B portion, where the share price performance was quite phenomenal. So during this period, we considered healthy growth as economic growth together with loans growth was largely in line. Right, so what happens when your loans growth outstrips your GDP growth? Usually it's a sign of bubbles emerging, right, and then following that we'll see recession. Right. However, for this period it's a little bit more unique because credit is cheap due to interest rates being really low. But the key thing we can see is that the GDP growth, domestic GDP growth, is slowing down and is stagnating. So again, the Singapore banks are usually a play on economies that they are exposed to, as well as the sectors that they are exposed to as well. All right. So of course, this has evolved over the years, but largely so, our Singapore banks are a reflection of the ASEAN economies. All right. So overall, we are seeing concerns on slowing growth across the regional economies. So together with our domestic growth slowing down, this equates to a stagnated loans growth going forward. All right, so again, healthy growth in GDP and loans, that is the one that's actually driving higher valuations as well as share price. So we look over here, the ROE versus the price to book valuation for the banks. All right. So over this period where there was healthy growth, right, we see ROE increasing and the banks re-rating upwards. Towards the course of the last 2 years, although we see ROE improving, right, price to book is still trading about 7 to 10% discount below the 10-year mean price to book. Right, for us, we believe this is largely justifiable as going forward, right, the economic growth as well as loans growth is projected to slow down. Right, so next up, when the interest rates increase finally, all right, we do expect credit costs to normalize, right. Credit cost simply means the amount of provisioning that needs to be done that's charged on the P&L, right, against the total loan balances. So if you look over here, right, the suppressed interest rate environment, right, has driven demand for loans. So we have seen quite sustainably high loans growth over the last couple of years, driven by low interest rates. But since interest rates are going up, right, projected to go up, all right, and the economic growth is slowing down, loans demand will slow down as well. So non-performing loan formations and credit costs are extremely low due to interest rates being low. So your borrowing cost is low for companies and individuals, right? So therefore, we expect the credit cost to gradually normalize as is at unusually low levels currently. Right, so asset quality will still be manageable if interest rates are gradually moving up. So For the three banks, their exposure to the oil sector as well as commodity sector is pretty limited, so it's about less than 10% of their total loans book, which they do not disclose what is the full amount. But as the banks are reporting this week, right, we expect to get more clarity on this, right, as there are quite a lot of concerns in the market over what's the true exposure to oil companies as well as commodities-related companies. All right. So with that, we'll end off our presentation here for today with the key investment actions, right? So Singapore banks for FY15 is still on an overweight, but we are more cautious going to FY16, right? So we'll keep an eye on the performance of the regional economies. So the uptick in recent SIBOR is a net positive for the banks going to the second quarter of 2015. For this year, we do expect higher net interest margins, but EPS growth will slow down. So on an average basis, we're expecting about 7 to 8% EPS growth only for this year. All right, for FY16, again, we're not too optimistic. Interest rates are going up, loans growth are slowing down. This does not bring about higher valuation for the banks. All right, so DBS is still our top pick currently, right, since their balance sheet is more geared towards a rising interest rate environment, and they do have quite a big exposure to USD appreciation since they have the biggest USD pot amongst the three banks as well as Hong Kong dollars. Right, so these are the calls as well as target price for our three banks. Right, so that I'll end it off, and please feel free to ask us any questions. Sorry. Hi, Benjamin here. There's a question on OCBC loans growth ticking up, whereas the last two banks have actually been slowing down. So the increase in the loans growth over here for OCBC is actually due to the consolidation of Wing Hang Bank's books. So if you strip that out, OCBC is about 2% quarter on quarter. Alright, so it's roughly in line with the rest of the banks. So for this quarter, fourth Q, we also expect about a maximum of 2% growth quarter on quarter. Alright, there's also a question of whether there's a risk of NPLs from local property markets hitting the books of the banks in a big way. So yes, the exposure to the property side for the three banks are quite substantial. We're looking at about 25 to 30%, with UOB being the highest, right? But the key thing to look at is the split between whether the property books that are being exposed, are they towards home ownership or investment properties. So for investment property side, UOB is the most exposed to that. Alright, so whether when SIBOR or the SOR increases, the repricing comes in about 3 to 6 months later. So of course, if there's a gradual rate hike, the NPLs will not show up until probably we see a sudden jump beyond 1%. All right. And then for our target price for the banks, yes, it's 12 months looking forward. So if you look across the different sectors, for FY15, the banks are still poised to outperform the rest of the sectors, right? Because naturally, if interest rates are gradually creeping up, they will take advantage of that first, all right? But longer term wise, when the loans growth slow down, right, on a 2 to 3 year horizon, that does not bode well for the banks. Okay. So it's another question on does it mean that OCBC has a higher chance of the share price going up? All right, based on our valuation wise, DBS still has the largest upside potential. All right, for OCBC, I think the key risk will be on how successful the integration of Minhang Bank is going to be. All right, because usually with M&A coming in, right, there are quite a lot of integration costs that will show up in the next 2 to 3 years. Right. But of course, for this quarter, we can expect to see the full impact of them consolidating Bank of Ningbo, all right, which became an associate. So you'll see an increased contribution from that, as well as Great Eastern Holdings has reported their earnings last week, and they did really well for the fourth quarter, right? But across the board for the three banks, right, for the core operations itself, fourth quarter is usually a slower quarter, all right. Net interest income usually slows down, right, because loans growth is slowing down, all right, but the margins should be stable. But for non-interest income like trading as well as fees, it's generally a slower quarter in the last quarter, as well as costs will go up because this is the part where the banks pay the bonuses, right? So usually the cost to income ratio will also bump up as well in the fourth quarter, right? And also we can expect continuation of scrip dividends, especially for OCBC. Right, and UOB, there is a potential for special dividend as well. Okay, for the banks, exposure to luxury property segment, from our conversation with the banks, we expect it to be UOB. So if you have seen the news recently, they were actually suing one of the property developers for a couple of properties in the Sentosa Cove area, right? Which actually they have fully provided for it in their loans provisioning, right?
Hi, there's a question on which, as in Philip, which particular period that we are expecting a Fed to increase rate, likely which month. Actually, we do not have a specific month to say, but we are speculating at probably at after September, when most of the economy probably will be able to see some of the effect filtering through some of the effect of the monetary policy easing to filter through the economy, and probably that would be a more proper environment for US to hike their interest rate. As for there's a question on Shanghai market, whether the bull market is over with last 4 weeks of drops. Well, for the because of their economy is slowing down, and I think the Chinese central bank is also quite concerned about the financial market and a capital outflow. So probably with the monetary policy easing, it should be able to support the equity market in near term. Yeah.
The question of the US is tightening the monetary policy, but Europe, Japan, and China is loosening, and what's the net effect on our banks? Alright, US monetary policy tightening will increase the interest rates, which results in our SIBOR as well as our SOR moving up. right? But Europe, Japan, and China, Europe and Japan less impact on the Singapore banks, but China losing the monetary policy, hopefully it will stimulate the growth of China, right? So with China growing, this will be more steered towards affecting DBS as they have the highest exposure to China side. So hopefully this stimulates the trade flows and they can increase the amount of trade loans as well as trade-related fees coming from there, right? But all in all, if you examine the regional economies, we're seeing headline news of inflation going down, economies are slowing down. Alright, so that's a net negative for the banks, right, going forward to FY16. Currently we don't have any coverage on Malaysian banks as well as Malaysian markets.
Hi, Hong here. There's a question on SIBOR, the rising SIBOR, and how is it going to affect REITs? Now, there's a general perception that as SIBOR rises, because when SIBOR rise, they are going to affect property prices. In that, it generally leads to a downturn in property prices, and REITs, when SIBOR rises, they will have to pay more interest. But what we can see is that generally at the REITs level in Singapore, most of them have adopted a very prudent approach in terms of financing. The general gearing level now is about around an average of 33 to 34%. And and because most REITs, they can also see that interest rates are going to rise. They can foresee this, and a lot of them have already done hedging in the sense that they have hedged most of their interest rates and to fixed rates using hedging instruments. So in that sense, this rising SIBOR would not affect them in a huge way. And on the other hand, if SIBOR is rising because generally the economy is performing well, we do not see why that would affect REITs in a huge way, because if economies are performing well, generally REITs, if you look at historical trends, like from 2003 to 2007 when interest rates were rising, the REITs actually shown a positive correlation to the equity side, and they did not really behave like fixed income in the sense that when interest rates go up, they will go down. So in that sense, when SIBOR rises as a result of improving economies, REITs should do well as well.
Hello, there's a question on Cinema Lens. Sorry, but for now we don't have any further updates on Cinema Lens. Cinema Lens should be having the results at the end of the month. We shall update accordingly then. Thanks.
Hi, just a quick question on difference between SIBOR and SOR. So SIBOR is actually the agreed rate that the banks are willing to lend money to each other, right, which is priced every day, and your SOR is a swap of a rate, which is expected for a point between a USD and SGD, right, be it on a 3-month or 6-month tenure. Right, so what's the current view of OCBC's acquisition of Wing Hang Bank, and when will we start to see benefits flowing to the share price of OCBC? So EPS accretion as well as valuation accretion will only come in expectedly in 2017 onwards. All right, and the current view of acquisition of the bank itself is largely bearish from our side, right? Considering that this, for our house view, is that there are not much synergies between the structure of Wing Hang Bank as well as OCBC. OCBC's reasoning for buying Wing Hang Bank is to tap on the corporate banking side over there to actually grow the SME pot as well as tap on the trade flows for China. But remember that for OCBC's penetration to China, they were usually targeting the large corporates. So for us, we can't see any reason how you can use the localized branches to access and grow your trade portfolio, right, through small SMEs. And of course, for Wing Hang's side, the quite large portion of their loan books is also exposed to the mortgage sector for Hong Kong. Yep. Right, with that, we end off our presentation today. Thank you for tuning in to our weekly webinar. Please look forward to seeing you guys again next week. Thank you very much.